Good evening, everyone. Thank you so much for joining us on this beautiful day. We are glad that you're here to learn a little bit more about home buying. Thank you for registering and signing up. My name is Sarah Scruggs. I'm the Community Engagement Specialist at Harvard University Employees Credit Union, and I will be just here right at the beginning, and then we will have one of our mortgage loan experts speaking for most of the presentation. We have my colleague Migdalia Gomez watching the chat. So if you have questions, please don't hesitate to let us know. To go through a couple of different housekeeping things, first being that we have gone ahead and muted everybody on the call except for our presenters. So hopefully you can hear us and continue doing whatever you need to get done today. And we don't want this to take away from the conversation at all, because at the end of the day, this is your all's presentation. So we will be using the questions feature, either that or the chat feature that you see on the right-hand side of your screen or at the top of your screen, depending on how you logged in today. So if we can just make sure, number one, that you can hear me, and number two, that you know where the questions or chat feature is. If you could let me know when you are planning on buying a house. This can be an extremely rough timeline. You don't have to do that. You don't have to have a specific month or day, but if you can just let me know when you are planning on buying a home, that would be great, so that I know you can hear me and you know where the questions feature is. You will be receiving the presentation in an email either tomorrow or Monday. And the presentation will also come with a recording. So that way, if there's something that you miss, or maybe you aren't able to be here the entire time, you're still able to get this information. So know that that will be made available to you. It looks like we've got a couple people answering within 3 to 5 years by the fall. So definitely a wide range of timelines here for you to cover. I'm sure there are people on who are thinking within the next couple of years, but it's always good to start early. And by doing this, you're starting, which is a great thing to do. At the credit union, we do have 4 different mortgage loan experts that are available to help you. And today with us, we have Michael Levine, who's joining us and will be taking us through the rest of the presentation. So I will welcome him now. And if you have any questions, don't forget to put those in the questions box. Take it away, Mike.
All right, thank you. And thank you everybody for joining us. I know right at the first slide they showed the picture of that beautiful house. I was going to tell everybody, use your imagination and pretend it's a beautiful summer day, but it looks like we're not far off. But anyway, thanks again for coming. And I'm one of the 4 mortgage originators at the credit union. You see the pictures here, Sharon Cummings, Helen, Daisy, myself. Normally before we went remote, we each worked out of a branch. Daisy worked out of LMA, Helen at Mass General, and Sharon and myself at back in Harvard Square. So hopefully when things return to normal, people will be at branches and make things more convenient for you. But, if you go to our website, you'll see that we're all available. You can go online and book appointments with us. And, we're happy to, work with you and answer any questions that you have. Okay. All right, I'm going to make the assumption that, most of you here are first-time buyers. And as first-time buyers, there are some benefits available from the credit union. First one is you get a 0.125% discount on the interest rate. So, when you look at the credit union's interest rates online, you'll see 2 sets of rates. And for a first-time buyer, they'll all be 0.125%. Now, first-time buyer is defined as somebody who has not owned a home in the last 3 years. So if somebody has owned a home 3, 4, 5 years ago, you'll still be considered a first-time buyer. And in addition to the discount on the rate, you're going to get a $500 credit towards your closing costs, which I'm going to go, that'll be coming up later in the slide. We'll offer you a free pre-approval, which will be good for 90 days. The pre-approval we'll get into as well. In addition to the closing cost credit, one of your fees will be a attorney's fee, and as first time buyers, that too is going to be reduced by $150. Additional benefits, the four of us, the originators, we're all available. I don't know if I want to quite say 24/7, but pretty close. We're used to working weekends and nights, in a competitive market where people are always needing pre-approvals, updating pre-approvals. It's just a situation where we've got to be available all the time. So we're used to getting, contacted at night or Saturday afternoon, Sunday afternoon, whatever. So, as you get involved in the process and need updated pre-approvals, we're going to be available for you. Okay, and you can see right at the bottom of the screen, it shows you how you can go online to our website and schedule an appointment. Normally, when somebody's buying a home, they're going to start off by getting pre-approved, then engage with a real estate agent, start the process of looking at homes. Eventually they get their offer accepted, they're going to get their mortgage. Just the way this presentation is set up, it's going through the mortgage process first. I'm sorry, the home buying process, then the mortgage. So let's, for the purpose of this, let's just assume that you've already been pre-approved and now you're starting the process. So you want to decide, is it the right time to buy? There's a number of factors you want to look at. Number one is, do you have your down payment funds? You need to figure enough for your down payment, closing costs, but that's something when you doing your pre-approval, you can get a better idea, what you're going to need. Couple of the primary things you're going to be looking at is the housing prices and the housing inventory, which have a relationship. Anybody who's been looking at properties will find that that unfortunately there isn't a lot of inventory in the greater Boston area. Unfortunately, I guess with low inventory, that drives the prices up, which is nice for the sellers, but not for the buyers. So, with right now, with not being many properties available, it's just making the process, I should say, quite a bit challenging. On the other hand, if it was the other way around, where there was a glut of properties, it's going to make the process a lot easier for you. You'd be able to negotiate the price. But again, we're not in that type of market. And another thing you want to look at is interest rates. Right now, interest rates are probably like in the low threes. And, you've heard a lot of talk recently that rates have gone up. But, even in the low threes, those are still pretty good rates. If historically, you look where rates have been, many you can just talk to your parents and see what rates were when they bought, but still, the rates in the low threes are still, pretty attractive. Okay, next. Okay. All right, so, also, another thing you want to look at is, some of the benefits of buying a home. The first item you see there is build equity in the property. Equity is defined as the value of an asset, or in this case, a property, the value less what's owed on it. So if you were to buy a property for, say, $500,000, put down 100, you get a mortgage for 400, that $100,000 is your equity in the property. That's your investment. Over a period of time, let's hope that, hopefully the value of the property is going to go up, your mortgage balance is going to go down, and the amount of equity that you have in the property is going to increase. So, eventually, if you go to sell the property, after a while, maybe that $100,000 is, 200 or whatever. But again, you have to look at the property is not just someplace you're going to live. You want to look at it, from an investment standpoint as well. Also, another thing is the tax benefits. You know, you often hear people say, well, you need to buy a house to get have the tax write-off. When you have a mortgage, you know, there's a good chance that you're going to end up paying maybe $12,000-15,000 a year just in interest. And you're going to have property taxes, you know, those could easily be $5,000-6,000 a year. Well, a portion of that is going to be tax deductible, and I don't want to get too involved in, you know, the tax issues because, you know, it's pretty complicated. But what'll happen is when you're doing your taxes, you'll be able to determine that a certain amount of the taxes and the interest can be written off. And when I say written off, let's just suppose the amount is 10,000. When you're doing your taxes, if you see your total income is say 80,000, and then you have 10,000 you can write off, that $10,000 comes right off of your income and reduces your taxable income to 70 and reduces your tax obligation. But again, I don't want to get too involved in the tax issue, but there definitely are tax benefits to owning a home. All right, selecting the right real estate agent. Now, I'm going to strongly recommend that everybody establish a relationship with a real estate agent when you're ready to start. I know with today's technology, you could just go online and see what properties are available. But real estate agents, you know, they know the market better than anybody else. You know, if you're going to look in a particular area, you establish a relationship with a realtor in that area. You know, they know what properties are for sale. They've seen they've been inside a lot of them. You know, they know what the values are. So it definitely makes sense to engage with a real estate agent. You know, they're going to do a lot of the legwork for you, you know, to go around and look at properties. But one of the most important factors is the fact that it's not costing you anything. The real estate agents get paid by the seller. So when a seller is selling the person is selling a property, they will engage a real estate agent to sell the property for them. They're going to pay them a commission. It's usually around 5% of the purchase price. So that'll come from the seller's proceeds. But when you as a buyer have an agent, the two agents are going to split that fee. But again, regardless, it's not costing you anything. And, you know, you've got somebody doing a lot of the, you know, legwork, so to speak, for you. So, you know, I would strongly recommend having an agent. Yeah, I'm going to skip over these agency relationships. But just as far as what you want to look at in an agent, oftentimes the best way is on a referral. If you may have a friend or relative that's purchased a home recently, and they have an agent that we're comfortable working with, you know, that's an excellent way to go. You want to make sure that the agent works in the area is based in the area that you're looking at. So for instance, if you're looking, let's just say in Cambridge and Somerville, you want to make sure you're working with an agent that handles like Cambridge, Somerville, some of the Arlington, some of the, you know, all the surrounding towns, because they'll be most familiar with the area. You know, you don't necessarily want to have somebody that's based out of, you know, let's say West Roxbury, because they're not going to know, you know, this area as well. So again, you want to make sure you get somebody that's in the area, you know, that does this full time. You know, I'm not sure now, but you know, one time you had people that just did this part time or just on the weekends. But you know, having somebody that's, you know, full time and does it, you know, 7 days a week, you know, that's your best bet. And as I mentioned before, you're not going to pay any fee because that'll be paid by the seller. Now, when you're looking for a home, I mean, you're going to establish a relationship with your real estate agent, and you want to let him or her know, you know, exactly what you're looking for. So as properties come on the market, they'll look at the property, and they will have many people that they're working with, and they can look at it and say, okay, who would this property, work for? And so if something comes on the market, they think it might be something you'd like, they'll contact you. And just some of the things to look at. I'm just going to go to the second bullet point first. Is make the agent aware of your likes and dislikes. And these are things that you'd like to have in a house, but they're not deal breakers. Let's suppose you'd like to have a big yard, or you'd like to have a garage, but if you find the right house and it doesn't have these things, you're fine. They're not deal breakers. As opposed to the first bullet point where wants and needs, those are items that are a bigger priority. You may want to be in a certain school district because of your children. Maybe, you definitely need to have a garage for whatever reason. Also, public transportation is another area to be concerned about. Us working either Cambridge or Boston, a high percentage of us use public transportation. So, for many of us, we need to make sure that the property is accessible to public transportation. When you're engaging with a real estate agent, they'll properties come on the market, they're going to give you an idea what the property is worth and what you might be able to buy it for. And granted, I know this type of market is unusual where it's, look, this is the price, take it or leave it. I, not to date myself, but, I look back when I bought my first house, like in the early 90s, there were plenty of houses to choose from. You get together with a real estate agent, look at several properties. But, that's when a normal market, that's pretty much what you do. Whether that type of market comes back again, who knows? All right, other than things to consider, as far as the community. I mean, many of you, when you get to that point, you may already decide that you know exactly which community you want to live in. But just things to look at when you're choosing a community. For many people, they look at the school districts. People who have young children or maybe preparing to have young children, they may want to look at the quality of the school district. You can go to the Mass Department of Education. You can get there's all kinds of data available with like test scores, things like that. Boston Magazine, at least once a year, I know they have these articles rating the various school districts. So there's a lot of data available, as far as school districts. Moment ago, I mentioned commuting. That's another thing, to consider. You want to figure out if you do need public transportation, how is this property going to do as far as a commute? You can actually go to the MBTA website where you see that mbta.com/rider tools. You can go into that area of the site, put in the property address where you want to buy, your work address, and it will tell you exactly how the commute, what you would have to do for a commute. Like whether you could just, get on the red line, or whether you got a green line, whatever, whether you got to take buses. Will give you, exactly what your commute would be, and it would help, make your decision for you. And then, there's all kinds of market research available, things that you can do on your own. All right, so in the purchasing process, let's assume, you're engaged with a real estate agent, you've looked at properties, you've gone through a negotiation process, and you've come to an agreement on buying a property. So in Massachusetts, as far as the legal documents you're going to sign, there are two primary documents. One is called an offer to purchase. The other is called the purchase and sales agreement. And as you get involved in the purchase, into the process, you're going to hear the purchase and sales agreement referred to as the P&S. So, get used to that term. But these are the two primary documents you're going to see. Now, the offer to purchase will be the first one that you sign, when you first come to an agreement with the seller. Typically, this is like a 1 or maybe 2-page document. Doesn't have a great amount of detail. It'll have the buyers and sellers' names, the purchase property address, purchase price, when the closing will be. Closing is the day that you're going to take ownership to the property. And normally when you sign the offer to purchase, you're going to give them $1,000 deposit, which the real estate agent will hold. And, that is refundable. And I'll get into that in a minute. But in your offer, you just want to put, as much detail as you can. Oftentimes, when you're buying a home, the seller may agree to keep give you the refrigerator, things like washer and dryer, swing set, something like that. Sometimes those can be negotiable items, but whatever items are going to be included, you want to make sure that they are in the agreement, because if they're not in there, it's not necessarily enforceable. But when you sign that offer to purchase, typically it's going to be subject to a satisfactory home inspection. And what'll happen is, it's not required, but most people will do it. They hire a home inspector, and not to be confused with a real estate appraiser. A real estate appraiser will be hired by your lender to determine the market value, but a home inspector looks at the property from a structural standpoint. Things like the roof, the electrical system, what else? The foundation, plumbing, things like that. And again, it's not required, but most people always do it. It's probably going to cost you somewhere, around $500 to $600 to do it. But I think it's money well spent. I would strongly recommend that you go with the inspector when they do it, so you see exactly what what they're talking about. I know loan I'm working on now. The woman had her offer accepted. She did her inspection and found out there were some major problems with the property, and she was able to walk away. So just know you're making that $1,000 deposit, but again, it's subject to the home inspection. Sometimes you might have some problems, and you go back to the seller and you might renegotiate the price, or sometimes it's bad enough where you just say, forget it, I want to walk away. So if you're looking at, how much you spend for the inspection, yeah, you're out $500 to $600, but it could be money well spent as far as, saving you from any potential headaches with a property. Okay. Okay. Now, I mentioned before the things that the inspector will look at. Another thing is, the pest inspection, if it's got termites, things like that. Radon, which is a colorless gas that comes up from the basement. Typically you can't even, colorless and odorless, so you couldn't even smell it, but they do a test, determine if there's any radon. The septic system is something that they don't necessarily have to be involved in, because any property in Massachusetts that has a septic system, the septic system has to be tested, has to pass a test from the city or town's Board of Health. So before you can close on it, so you're protected that way. So the inspector doesn't necessarily have to look at the septic system. But again, these are all things that, are going to be looked at. And, if you just decide that, you don't have a good feeling about the property, you may want to just walk away and just, hopefully, another property will come along. Now, the purchase and sales agreement, we'll make the assumption that you've had your home inspection and, worked through any issues. A purchase and sales agreement is a much more detailed document, which is, probably somewhere around 15 to 20 pages. And this is a one that, dots the I's and crosses the T's, so to speak. This is the one that once you sign this, I mean, you are legally bound, I should say, to buy the property. I would strongly recommend that when it comes time to sign this, that you have an attorney representing you. This is something that, very high percentage of people will do, because, I mean, you're doing something you've never done, so you want their expertise in, guiding you through the process. They may advise to have certain language and inserted in the purchase and sales agreement, things to protect you. But the key items in the purchase and sales agreement, it's going to have some crucial key dates. Number one, it'll say, what you have to apply for a mortgage by a certain date. Even though you've been pre-approved, you still have to, go through the mortgage approval process. It'll also show the closing date, which is the date that you're going to take ownership to the property. That's something you'll negotiate with the seller, but typically that's somewhere, in the range of 30 to 45 days. And oftentimes that might be, predetermined, if you will, because the seller might be buying another property and have a closing scheduled on a particular day and needs to close on that day. Another key date is what's called a mortgage contingency date, which is the deadline by which your mortgage has to be approved. And normally that's somewhere about 7 to 10 days, prior to the closing. So, if you've got a real estate agent you're working with, they're going to keep an eye on that date and make sure that you get your mortgage approved. When I say it's a contingency, because for whatever reason, if your mortgage does not get approved, the deal is off. You're not bound to buy the property. Also, with that date, when you submit your application, it's the lender's responsibility to make sure that, they're able to deliver the commitments, by that particular date. But again, I would strongly recommend that you have an attorney represent you in reviewing the purchase and sales agreement. That's going to be an additional fee beside your closing costs. And depending on how much you have them do, it could be like another $300 to $400. But again, it's money well spent because, again, you got somebody watching out for you. And again, because it's something that you've never done before. All right, so now the home financing process. Now, I know I mentioned before, we're going to make the assumption that you've already been pre-approved, but still, even though you've been pre-approved, the pre-approval, you submitted a very basic application, not a lot of detail. Now that you've found a property, you have to go back, excuse me, and then, submit your full mortgage application, where the lender is going to need a lot more detail from you. You're going to submit an application, and if we can go to the next slide,
Mike,
yes,
may I take a moment and ask you one of the questions that came in,
yes,
and hopefully give you a chance to take a moment for yourself. Thank you for that. So one of the questions that came in, how do you know you're getting the best interest rate? Is there a strategy that you recommend for shopping around for rates?
Well, first of all, as far as rates, when people get pre-approved, I know a lot of times people are also looking at interest rates when they start the pre-approval process. However, they may not find a home for several months. So typically what I tell people is, get your pre-approval, don't worry about interest rates. Once you get your offer accepted, then you want to shop around. Just, go online to different, identify, a number of different lenders, and see what rates are at. Obviously, if you've been pre-approved by a particular lender, you'd like to go with them. But, if you see that somebody else has got a rate of, say, 0.25% lower, it might be in your best interest, to go with the lower rate. Generally most lenders are going to be within a certain range, maybe within 0.25% of each other. But, I would definitely tell you to shop rates, and, as much as the credit union wants to get your business, you want to make sure that you get the best rate out there.
Thank you, Mike. We have about 30 minutes left. There is
Okay.
another question, but it's about
Yeah.
down payment, so I'll wait until you get to that
Okay.
section.
Yes. Yeah. Okay. All right. So if we can go to the next one. Okay. So and again, this kind of goes back a little bit to when you're doing the pre-approval, but a good area to start is on your credit report. I know in this day and age, most people have a very good idea what their credit scores are, and which makes the process a lot easier for you. If you don't, it's probably a good idea to get a copy of your credit report first. There's a couple of sites where you can go. One, if you see on the bottom there, annualcreditreport.com. Another one is myfreecreditreport.com. You can go to these sites. By law, you're entitled to get a free credit report once a year. So, it's a good idea when you're starting the process. If you're comfortable with the fact that you got a good credit history, fine. If you're not sure, get a copy of your credit report. Occasionally you might find out that you had some delinquent accounts that you weren't aware of. Sometimes you get these like hospital bills that the insurance company didn't pay, and they get sent to the collection agency, and you weren't aware of it. It brings your credit score down. So things like, it's a good idea, get a copy of your credit report. It states here that we recommend 720 or higher. Yeah, we'd like to see that score that high, but we do plenty of mortgages where the scores are in the, even in the mid 600s. So, don't be, that concerned with, having a real high score, because again, a lower score is going to be okay as long as any delinquency you had, was in the past and your recent credit is satisfactory. All right, how much can you afford? So when you're going through the pre-approval process, you've already, most likely you've determined how much you have available for a down payment. So when you take that, plus the amount of a mortgage you qualify for, that'll help determine the purchase price to be looking at. So when you start the process, the credit union has a process called the express pre-approval. It's a very basic application from our website. You submit it, an originator will get in touch with you, get an idea from you what your salaries are, get a rough idea what you're looking at, what you're hoping to buy is, what your purchase price, down payment. And, it helps before you're starting the process, do some shopping, try to get an idea, of an area, a type of property you're looking at. But just know when you get that pre-approval, this is just like a starting point, because you may say, okay, I'm looking for a $400,000 condo with $50,000 down and a loan of $350,000. As long as you qualify, we'll issue the pre-approval letter for those terms. But once you start looking, you may find out, gee, I'm going to have to go up to $450,000. And as long as you qualify, we can easily revise the pre-approval letter, and it doesn't involve going through the whole process again or getting a new credit report. Pre-approval letter will give you is going to be good for 90 days. And, if you're getting close to that 90 days and haven't found anything, you come back to us and, we can certainly extend it, for another 90 days. The process, when you submit the application, generally we can pre-approve it. It says here 48 hours. I can safely say, it'll be within 24. So, let's just say that you decide, you find out about a property that's coming up, that's going to be on the market over the weekend. You want to look at it, and Friday morning you go to our website and submit your application. There's a pretty good chance we'll be able to approve it for you so that you can have the pre-approval letter for the weekend. Just, some of the guidelines to look at, when you're buying a property is, the lenders are going to use a couple of different income ratios. And we're going to look at your housing payment, which is the principal and interest. If it's a condo, you're going to have a condo fee. All properties, unfortunately, you're going to have to pay taxes on any property you buy. So when you're looking at properties, you'll see the little information sheet. It has all the detail about the property. You want to see how much the annual taxes are. And whatever that annual amount is, divide that by 12 for the 12 months. That's going to be part of your monthly payment. So if you see a property where the annual taxes are, say, $4,800, divide that by 12, that's $400 a month. As part of your payment, you're going to pay an additional $400. The lender is going to put it aside in what's called an escrow account. It'll just sit there. And then when you have a tax payment due, the lender will get a bill and we'll go ahead and pay your taxes for you. I've always done that on a mortgage, and it just allows you to budget your money instead of having to come up with a big sum of money, twice a year or four times a year. But again, that housing payment is the principal, interest, the taxes. If it's a house, you're going to have homeowners insurance. But that housing payment shouldn't be more than approximately 36% of your monthly gross income. In mortgages, we're always looking at the gross income, the amount before taxes, and we always look at it on a monthly basis. So, if you're used to looking at your salary, say annual, we would just divide it by 12. But again, we look at it the monthly. And then we're going to look at what's called a debt ratio, which is your total payments, the housing plus anything else. When I say anything else, it's the type of things that will show up on a credit report. Credit cards, loan payments, things like, utility payments or, gym memberships. Those things don't count. But the total debt ratio shouldn't be more than about 43%, of your monthly gross income. So this is something when you're going through the pre-approval process, you're sitting down with an originator, sometimes there may be situations where somebody has a lot of debt and they may not qualify. And, an originator might say, you might be better off paying off some of your credit cards first before you apply. But if you're in that situation, if you think you might be in that situation, I would not go ahead and pay anything off until you've sat with an originator, and let them guide you on it. Because, you may pay off, debt that you didn't have to. And then, of course, the more you use to pay off debt, the less you have available towards your down payment.
Mike, thank you. I just want to take a moment. We have a good amount of questions and we have 20 minutes left. So I think I'm just going to ask you the questions so that folks can get their information. I know some of this you might go into more detail. One of the questions that came up, do you offer VA loans?
We do not.
And another question that came in is, what if you have school loans?
School loans, they will count, in your debt to income calculations. oftentimes on the credit report, it will show the monthly payment. Oftentimes loans are in deferment and you're not making payments. Unfortunately, those do have to be considered. So if the credit report does not show a monthly payment, we would take 1% of the balance and use that as the payment and include it in your debt to income calculations. So unfortunately, those do have to be considered.
Thank you. Another question that came in, how many times can you extend the 90 days? Would it just make sense to do it again since I'm not ready for a few years?
I can't speak for my colleagues. I mean, I do it several times. I do it several, probably maybe 2-3 times anymore. I generally like to see the credit report is, within a year. If somebody's coming back and it's maybe 8-9 months, I'll just ask them, has anything changed? And I'll, take them at their word. If they say the salary's around the same, they have no new debt, normally I'll take them at their word. Once you get up close to a year, then I prefer to get a new credit report.
Thank you. And the next question has to do with down payment. I know that's coming up, but a lot of folks are asking, how much do you recommend for a down payment? We have about 20 minutes left, so I probably will, I'll hold the next questions until 10 minutes up. So I'll reach out again then.
Yeah.
Thank you.
Okay. Now, as far as the down payment, you'll always hear, people tell you, especially like older people who bought homes many years ago, oh, you got to put down 20%. When you put down 20%, if you put down less than 20%, you're going to have the mortgage insurance or PMI, which is going to be an additional part of your monthly payment. But you can put down as little as 5%. It's easy to say put down 20%, but when you look at what the price of houses is in this market, 20% is pretty significant. And also, when you're buying a property, it's nice to put down as much as you can and have as low a mortgage, but you also want to keep in mind, good chance you're going to have money left over to do work on a property. So, when you're considering a particular property, you probably want to have an idea, okay, I'm going to have to remodel, I'm going to have to replace the carpeting, or I want to remodel the bathroom. I'm going to need a certain amount left over for that. So those are the things you've got to keep in mind. So, there's no right or wrong, but, generally speaking, you can put, as little as 5% down. But again, it's going to be whatever works best for you. Just go through this briefly on loan limits, different types of loans. Generally speaking, any loan up to an amount of 724.5 is what's called a conforming or conventional loan. And I'm guessing that many of you probably are not going to go over that amount. Anything above that amount is what's called a jumbo loan. And normally for a jumbo loan, the interest rate could be anywhere from 1/8 to 1/4% higher. There may be a higher down payment required. But again, I probably would safely assume that, few of you are going to do a jumbo loan. So, but when you're talking with, communicate with the lender to find out what their interest rates are, you want to make sure that you ask them the rate for a conforming, or conventional loan. Now the down payment, which, I touched on, but just to give you an idea, and I mentioned, the 5%, there are cases where you can do as little as 3%, as first time buyers. Depending on the county, there are limits on on your income, I should say. You can't make more than a certain amount. But generally you should figure on 5% for a single family home or a condo. If you're looking at multifamilies, for 2-family, you're going to need to put down 15%. or for three to four family, it's 20%. Now, there is an exception where you can put down as little as 5% for a two family, but for that you would have to get a adjustable rate loan, which I'll get to in a minute and just show you what that is. But, you know, again, as a first time buyer, I doubt many people, you know, are going to be buying two families. You got the 15% purchase down payment, but, you know, you're looking at a much higher, you know, average home price compared to a house or a condo. Okay. So with less than 20% down, then you're going to have the mortgage insurance, private mortgage insurance, also referred to as PMI. And this covers, you know, the lender's risk, you know, for you having limited down payment funds. You know, there was a period, you know, probably going back to maybe early to mid 70s where, you know, if you were buying a house and you had you couldn't buy a house with less than 20% down. It was just, that's it, 20% that you don't buy. And then a number of these companies established this process called mortgage insurance, where you can buy the property with less than 20% down. But again, you're going to have the PMI, which will be an additional part of your monthly payment. And just to give you a rough idea, assuming you put down 10%, you know, for every 100,000 you finance, it's going to be about $33 a month for 100,000. So let's say you're financing 300,000, you know, you're going to be roughly $100 a month as part of your monthly payment. I know it's easy to look at it as a negative, you know, paying the mortgage insurance, but again, it's allowing a lot of people to buy homes who normally wouldn't be able to, you know, especially in this market. And, you know, another thing to consider is maybe you have 20% down, but you might decide that you don't want to use your full 20%. You may want to save some of your money to do work on the home. So you might decide to put 10% down instead of 20, and the mortgage insurance, you know, will allow you that option. It won't necessarily be there for the life of the loan. There are a couple of circumstances where the lender has to remove the mortgage insurance, and you know, I don't want to get too involved in it because I know we're starting to run a little bit low on time. But again, it won't necessarily be there for the life of the loan. Just, you know that. Okay. All right, now which loan is right for you? It's giving you two options: the fixed rate first versus the adjustable rate. I'd say probably 95% of the loans we do are fixed rate loans. If fixed rate, it just as the terminology applies, your rate is fixed, it will not change. So if you take a loan at, say, 30-year loan at 3%, you know for the entire term of your loan, your interest rate and monthly payment will not change. And just because of that security, that's always what has been and will be the most, you know, popular loan. The other option is an adjustable rate loan, also known as an ARM, which does have some benefits. The initial rate is going to be lower than for a fixed rate. For instance, you may do a fixed rate loan, 30-year fixed rate at say 3.25. You might get an adjustable rate loan, and that initial interest rate is going to be probably about 0.5% lower. Now, the types of adjustable rate loans we offer are 5-1, 7-1, 10-1, and 15-1. By that terminology, I mean a 5-1 adjustable rate's going to be fixed for the first 5 years. After that, it's going to be reviewed annually, and the rate could change. The 7-1 is fixed for the first 7 years. If you're buying a property and you plan on being there long term, the adjustable rate loan probably doesn't make sense for you. Oftentimes people are buying their first home and they know they're not going to be there long term. Maybe because of their employment, they know they're going to be transferred eventually, or they're expecting a big promotion and they'll be able to buy something else. But if you're buying a property you don't think you're going to be there long term, the adjustable rate loan may make sense for you, where you're going to get that lower interest rate and the lower payments. Or if you're in a situation where your income is going to increase in a number of years, that lower payment will help you for a while, and until your income increases. But generally speaking, like I said, most people do the fixed rate loan, just because of the security.
Mike, we have another question that came in.
Yes.
Approximately how long does the process take from pre-approval to home ownership?
Well, pre-approval, you submit, excuse me, you'll submit your application for pre-approval, which generally we can turn around in 24 to 48 hours. So you'll get your pre-approval letter. So at that point, it's just a matter of how soon you can find a property. And that's really a function of the market. I mean, you may be lucky enough to find a property right away. You may be in a situation where you don't find a property for several months. But like I said, the pre-approval process itself, is very quick.
Thank you. We have 10 minutes left.
Okay.
I just want to remind folks, we will email you Mike's contact information and also the PowerPoint and recording. If we aren't able to get to the rest of your questions this evening, please know that you will have the contact information, and I will also drop it in the chat so that you can reach out to one of our mortgage loan originators, and I'll turn it back to you, Mike.
Earlier on, I mentioned that the closing costs. So, when you're figuring out how much you need to have available to buy a home, you figure your down payment, suppose you're looking at in the $400,000 range with 10% down, you need 40,000, but you also need to figure money for closing costs. It's going to vary on the purchase price, but you should probably figure on needing somewhere around $5,000 to $6,000. And the closing costs are payments to a number of third parties that are doing work on your behalf and on the credit union's behalf. There's going to be attorneys, real estate appraisers. There's registry of deeds, charge fees to record the mortgage. There's title insurance. So when you're starting the process, you want to make sure that you've got funds left over, for the closing costs. And again, I did mention that first-time buyers get that $500 credit, towards the costs. There are some mortgage programs available with the credit union where there are no closing costs. However, you're going to pay 0.25% higher interest rate, just because there are no costs to you, but there are costs that are being absorbed by the credit union. So to compensate, the lender will take, a higher interest rate. Okay, just, kind of a summary of the, what we call the roadmap, so to speak. When you're ready to start the process, you'll do that, express pre-approval. And as I mentioned, that process can be turned around very quickly. You engage with a real estate agent, hopefully find a property very quickly. You assign that offer to purchase. Then you'll have your inspection, everything goes fine. You sign the purchase and sales agreement. Then you're going to go back to your lender and submit your mortgage application. Even though you've been pre-approved, now there's a lot more documentation your lender needs. They're going to start asking you things like pay stubs, W-2 forms, bank statements, things like that, which they didn't get much of with the pre-approval. When you apply, you're going to get what's called a loan estimate, which is just a breakdown of your estimated closing costs. And you're going to get a number of disclosure forms, which, required on a from the federal government. But again, we have to, I shouldn't say try, we have to give you a very good estimate of what your closing costs are going to be. Years ago, when the laws weren't as stringent, the lender could give you what was called a good faith estimate showing closing costs, say $3,000. You get closer to closing and find out the 3,000 is now 5,000. So laws are in place to protect you. And when you get that loan estimate, that's going to be a very good indicator of what your costs are going to be. And there can't be a lot of variance, from that. As I mentioned, you're going to submit all the documents that were requested, the pay stubs, etc. Once the lender receives those, excuse me, while in the same time, they're going to have the attorney do title work on the property. Excuse me, we're going to order an appraisal of the property. Once we have the appraisal back, we have all the documents from you, we'll be able to issue your approval. It's mortgages, it's called a commitment. I mentioned before that contingency date. So it's important that, the lender has to be able to issue the commitment by that contingency date. And, it's important for you that when the lender asks for these items, that you get them there on a timely basis so that they can issue the commitment letter on time. Once your loan is approved and you're getting closer to closing, one thing the lender will normally do 2 or 3 days before closing, we always need to get an updated credit report. Make sure that don't have any new credit. So it's always a good idea when you're in the mortgage process, try to avoid applying for any new credit if possible. And we also need to verify your employment. So usually about 24 to 48 hours, we just call your employer and just make sure that, yes, they're still working there. And prior to closing, by federal law, at least 3 business days prior to closing, you will receive what's called a closing disclosure. They always refer to it as a CD. And this is going to look similar to this loan estimate, but it's going to give you the exact amount of all the closing costs, and most importantly, the exact amount that you have to bring to closing. The reason they give you the 3 days is just to make sure that you've got enough time to digest it, make sure you understand it, and that you're comfortable with everything. As opposed to years ago, they might give it to you 3 o'clock in the afternoon for a 10 o'clock closing and say, here, you got to come up with a check for 20,000, and you don't have time to review it. So laws have changed to make it a lot more buyer friendly. And quite often, before you close, maybe the day before or maybe a few hours before, you're going to go back to the property and do a walkthrough. You've looked at the property at the time your offer was accepted, but you just want to make sure that the property is still in the condition it's supposed to be. Maybe certain items were supposed to be removed. You want to make sure those are gone. Or maybe the seller is gone, certain items are supposed to stay there. You want to make sure those items are still there. So you'll do that walkthrough, like I said, normally, the day before or maybe a few hours before. And, one other thing is you're going to have to get an insurance policy before you close, but that's something that you'll coordinate with the attorney that's going to do the closing. So, when you go to the closing again, that's the process where you actually take ownership to the property. You're gonna, meet with an attorney. You'll sign so many documents, you'll be amazed. But it takes you probably, a good hour to, go through the process. It says to bring the certified check. Typically, what happens is the funds that you need for closing. Normally the attorney wants you to wire the funds to them the day before the closing. But again, you'll go through the closing. Once you sign the documents, that's it. You're a homeowner. You own the property. The seller is going to give you the keys, and you're ready to go.
Thank you, Mike. Great job with all this
Thank you.
information.
Thank you.
It's a lot to digest
It is.
for our attendees, I'm sure. But the good news is you'll have all of this in your hands once you receive our email, either again tomorrow or Monday, so that you can look through this again. So this isn't the last time you'll see all of this. We do ask if you could please complete our survey for us. This just helps us to know how we can improve and continue these sessions for you all over at Beth Israel. So and one last question did come in, Mike,
Yeah.
that I think would be good information. Does the credit union only do mortgages for those in Massachusetts?
Massachusetts, Rhode Island, and New Hampshire.
Perfect. Thank you,
And there's
Mike.
been talk about expanding to some other states, but where and when, I'm not sure. But for now, definitely those 3 states.
Perfect. So stay tuned for that
Yeah.
information. That will definitely be something that we let you all know about. But we thank you all for joining us this evening. Hopefully you were able
Thank
to
you,
get out
everybody.
there and enjoy the sunshine at some point today. If there are any questions that you have with follow-up, do know you'll have Mike's contact information. So if there's anything that we can talk to you about after this, know that that is welcome and encouraged. We hope you have a wonderful evening, and we hope to see you at one of our presentations soon.